Have you ever looked at your tax bill and thought, why the hell am I paying so much? As a director of an accounting firm, I've helped thousands of business owners reduce their tax bills by 5 figures just by making a few strategic changes before the end of financial year. In this deep dive, I'm going to show you how you can do the same. I'll go over 3 main strategies for legally minimizing your tax and real client case studies so you can make the most out of your tax planning session with your accountant. Let's dive right in. So this topic is why you're paying too much taxes and what to do about it. First things first, paying too much taxes means you have to be making money. A lot of businesses, they book in a meeting with me or they talk to an accountant and they say, Davie, I'm paying way too much taxes. And the first question I ask them is, how much is your effective tax rate? And they don't even understand what that means. And that's when I start getting a bit worried about their situation. So let me just quickly share my screen and explain what I mean by trying to understand if taxes are actually getting paid. So a lot of clients confuse income taxes. So this is just a group structure diagram that we draw for our clients, right? It starts off like something like this. This is the situation of a client. They might have a holding trust here. Or they may have just a trading company right now. So this is usually option 2. So I'm going backwards, but this is option 1. So they just set up sometimes we're a very small business and they just set up a individual name, set up a company and the individual owns the company. So that's usually the very basic structure a client comes in and this is what they say they're doing. Sometimes they even don't have a company and it's just a sole trader and instead, but most cases it's usually a company. Okay, so that's option 1, and then option 2 is a bit more of a more complex structure where they've got a trust that owns a company and they've got a super fund. It doesn't have to be SMSF, it could be just like an industry super fund that they're using. Okay, problem is when a client comes to me and they say, hey Davie, like I'm paying way too much taxes. The first question I ask is, what's your effective tax rate? And then the second thing I ask is, what taxes are you actually physically paying? So the problem is that a lot of business owners, when they're first time business owners, they think that they're paying a lot of taxes is because when they first had a exposure to taxes, the way the exposure of taxes was their taxes get paid before it hits their bank account. So the money gets withheld from their wages. They call something called gross wages, and the employer takes the part of their taxes and pays it to the government. So what actually physically hits their bank account is the net taxes that net wages that they receive. The great thing about that is that they don't need to pay taxes anymore because the taxes are being withheld. So they usually get a refund at the end of the year. But the issue is that when you convert to a business owner, it's the opposite. The money hits your bank account first, and then you take out the taxes at the end of the financial year or when you work out that you have a profit. And the reason why that's like that is because businesses don't know what they're going to make at the end of the year. They have to wait for all the expenses to go past and then be spent, and then they can work out the profit and pay taxes. That habit or that behavior changes when you're an employee versus a business owner. And the problem of being a business owner and doing that, you think automatically that you're paying too much taxes because the expectation is that the tax has already been paid and I should be getting a refund instead. But as a business owner, it's the opposite. You have to pay the taxes and it's a big chunk because you are not used to no one withholding the taxes for you. So as a result of that, what the client needs to figure out is that what actually taxes are they paying and what's the effective tax rate. So in Australia, there's tax rates for individual names. And you guys probably know this already, but I'll just quickly show you guys one more time. It's anywhere between 30% to 45% plus Medicare of 2%. Some people sit on the 16 cents in a dollar, but most people don't, because if you're sitting on 45K or less, you're pretty much in the poverty line, and your business is probably struggling a bit. Well, not just the business, but your family as well. So that's the downfall the Australian taxes is that your effective tax rate, like or your tax, not your effective tax rate, but your tax rate it's overall is quite high. So my question firstly is, I actually had a client come in and they owned a franchise business. It was a hospitality franchise. And I can't really name what the name of the entity was. It's kind of like one of those fast food ones, but the smaller fast food hospitality businesses. And they were making about $45,000, sorry, $50,000 in wages, husband and wife each. And they made about, I think it was like $40,000 in net profit and in their company. So I asked them like, what do you think your effective tax rate is? And they said to me, we're paying about 20% or something like that. I feel like I'm paying about 20%, and that's just too much, Davie. And I said, well, in order to live in Australia, I just wanted to remind you that the tax rates in Australia is about 30% if you're making any dollar over 30%. Any dollar over 45K. And one last thing is that if you're running a company, your company tax rates are usually anywhere between 25 to 30%. So if you click here, 25 to 30%. So just to be in Australia, the taxes are always going to be roughly around 25 to 30%. And if you're paying more than that, then that's the problem. I think if you're paying about more than 30% effective tax rate, then we need to consider tax planning, minimizing your tax. This topic is why you're paying too much taxes and what to do about it. But you first need to understand that there is a range of taxes that you should be paying when you live in Australia, when you operate a business in Australia. And that is anywhere between 25 to 30%. And if you think that's too much, then honestly, I'll be hard on you guys. Don't live in Australia because that's just how it is. You got to possibly figure out a way where you live in another country because Australia's taxes, it's very hard to get away with it. We live in a society where income hits the bank account, gets shown, it gets recorded. It's very hard for you to argue that the income doesn't hit your name. You can't. You need money to survive. You need money to pay for rent. You need money to get a loan, get a mortgage. If you're not making, well over $50,000, and paying a tax rate of, 30%, then you're gonna struggle. So you got to get used to the tax rate of 25 to 30%. That's the first thing I need to tell you guys. Okay, that's the part where in this topic, if you think that that's too much, then I can't really help you unless you move overseas and you live in another country, you make your income there and the disposable income is less, the tax rates are less, and maybe that's just a better standard of living for you guys. Okay, so that's the first thing I need to make sure that you guys are aware of. In Australia, taxes are quite expensive. Second thing I want you guys to know is the different tax rates for different entities. So if you have been living under a rock, I'll just show you guys this again, but I've explained it many times. The tax rates are like this. So I always argue that the tax rate for individuals is about 32 to 47%, rather than the 16 cents in a dollar or whatever, because there's no point doing the 16 cents because it's only up to 45K and no one can really survive on 45K. So these are the tax rates in Australia right now for individuals and companies and SMSFs. The trust doesn't pay any taxes. The trust, it acts like a pipe that distributes profit to elsewhere. And you would need something like this to be able to assist with minimizing your taxes. Right. So most business owners overpay taxes without even realizing it, because a lot of them don't realize that they can structure their business and structure the income that they make. So there are three main ways to minimize the taxes. And the three ways, let me just bring it over here. Three main ways. The three main ways of minimizing taxes is, let's just go, shifting income, shifting profits to other entities. Because, as I explained before, different entities have different tax rates. your personal name has a higher tax bracket. So, but it also depends on how much you're making. So, what generally is a rule of thumb is make as much as you can in your personal name that you need. So, what you need is basically paying for a mortgage, paying for rent, personal rent, paying for groceries, and paying for personal expenses. A lot of people say that my disposable income is like $300,000. I need $300,000, Davie, and I'm paying way too much tax because I'm on the highest tax bracket. There was actually some really wealthy, high net worth individual who sold his business for millions of dollars. And he basically said to me, David, like, I need to be paying myself like $600,000 a year. And I said, let me just stop you there. I don't think that you need to be paying yourself $600,000 a year. Tell me firstly why you need $600,000. So he first starts with, I'm a big spender. And I said, no, I don't think you're a big spender. What are you actually spending on? And he said, I've got a mortgage, I got a few investment properties. And then I said, that's where you need to stop. Because right now, the reason why you're spending so much in your personal name is because you've invested in your personal name. And that's why your mortgages need to be high. But you can actually shift your assets and investments into something called a bucket company or a trust or in your super fund, which has a lower tax bracket, which also doesn't need to result to being paying 47% in taxes when that money goes into that entity to buy those assets. So that's something that a lot of people don't realize. And that high net worth individual said, holy crap, I was buying everything in my personal name or buying it in, entity that was not, it was a trust that was not very tax effective when I needed to take that money out. Yeah, okay. So that's just something that you need to be pay attention to, which is that you don't need to have all your money or all your income in your personal name just because you want to invest. You just need enough money for spending, personal spending, and private spending. So, and generally, rule of thumb is anywhere between 100K to 180,000. Okay, that's enough for you guys to survive off. Okay, but that really depends on the person. Sometimes they do have a big spending because they're buying Lamborghinis, Ferraris, or whatever in their personal name, and as a result, during the time that you're buying those assets, you might need to take more money out and show that income in your personal name. However, if you have modest spending, if you don't buy any luxury assets and you're just paying for rent or mortgage personally, you may not need that much money in your personal name. Plus, don't forget, sometimes people have a partner. You can split the income between the two of you guys. So that 100 and another 180K means that you can take quite a fair bit of money out, less the taxes. Yeah, less the taxes in your personal name. So just a quick note that the first step, again, going back to it, was shifting your income in other entities. And that means shifting income in your personal names, individuals. So that could be like husband, wife, adult children, could be, parents as well. And then it could be like a company, which is at 25% tax rate. Could be a trust to redistribute profits. And it could be a SMSF or a super fund. There are many ways that you can distribute your profits. Okay, another method. So that was number two. That was number one, shifting profits away. The second way of minimizing your taxes is actually reducing your income. This one here, reducing your income, is something that a lot of people don't want to do as a business because reducing your income means less profit, means less tax. However, that means less money in your pocket as well. And it also means that your business or whatever you're doing is contracting. Okay, if you're retiring, it does make sense for doing something like that. But if you're a business, why the hell would you want to reduce your income? Okay, the main reason why you want to reduce your income is that you're not technically reducing it, you're temporarily pushing it back to another financial year. So you're temporarily pushing it to another financial year. So what I mean by that is that, let's just say that you've got these jobs that you could start in June and you can invoice it So when you usually invoice, and if you're a small business owner, you usually just send a bill, and it could be 10, 20%, or maybe even 50% of the actual project. So that could be like 10, 20K, maybe even $50,000. And as a result, that money falls in the current financial year. So if I send an invoice now to, David Smith, and then David Smith pays me that, $50,000 or $100,000, that means that money falls in 2025's financial year, and I have to pay tax on it. So what you could do is look over all the work that you are planning to start, and maybe it might not be a good idea to start it in June. Could be a good idea to start in July, because waiting those 1 or 2 weeks and starting it in July and actually not invoicing for it and not actually starting the job or whatever, that means that income actually falls in the next financial year in 2026. And when you lodge your tax return in 2026, that's after 30 June 2026. That's another year where you need to pay that taxes. So you're not technically reducing your income forever permanently. What you're actually doing is just delaying your income and letting it get reported into the next financial year. Okay, but you got to be careful. There's something called Part 4A, and you can't be doing this for the sake of just minimizing taxes. Part 4A taxes, which is general anti-avoidance rule. And basically, the ATO is stating that moving forward, so there is like a rule about tax schemes with the ATO. And basically, the ATO is just saying that you can't be creating a scheme to just purely to avoid paying taxes. Okay, that results to reducing your inflating your refunds, avoiding taxes. And in this case here, my argument is that yes, sure, you're getting a tax benefit, but really you're just not starting the job. You don't want to start the job. You've done some planning. You've decided that it's better just to do the work in July or in August. And so therefore, it's actually a business deal as well, a business operation planning. And you've planned that you're not going to do the work until next financial year. So therefore, the income shouldn't be reported this financial year because it hasn't been started yet. So remember that you got to do it right, and you got to provide evidence if the ATO were to look into it. But be careful with Part 4A and creating tax schemes as a result of this. But reducing income is another method. And the last method is quite similar, but the opposite of reducing income. It's increasing expenses. By increasing expenses, you get tax deductions. And by resulting to getting tax deductions, you will get your profit down. So decrease in profit. So therefore, you pay less taxes as well. So increasing expenses is another thing where it also is detrimental to your profit, because as a result, you make less profit, less money in your pocket. However, there's something called prepayments in the tax rules where you can actually pay any prepayment up to 12 months and still claim it in the financial year. So as small businesses, you can actually pay something that you don't expect to pay like right now, but you're going to be utilizing it next year. You can still claim it in the 2025 financial year or the current financial year. For example, insurances is one of them. Travel is another. Accounting fees. So we charge our clients on a monthly basis, but you can actually ask your vendor or people that you're paying or supplier and say to the supplier, hey, how about I just prepay your expenses for the next 12 months? I know I'm going to pay it anyway, but I just want to claim it now. By being able to claim it now, that means that you get a 25% tax refund or tax deduction based on your tax rate on these expenses that you know you were going to pay anyway, and you're going to claim it next year, but as a result, claim it this year instead. So they are the three main ways. Shifting profits to other entities that would help you reduce your taxes, because the other entities might have a lower tax rate. Reducing your income, that means your net profit goes down, and as a result, you pay less taxes. And then increasing expenses, so looking at expenses that you could pay. It could be prepayments, it could be some things that you didn't expect to pay, but you thought, oh, I can get a loan for it, I can buy it, I don't have to use my own pocket to pay for it. And as a result, those investments or those the car or asset that you purchase helps you get a tax deduction, but also helps you increase your income as well. So in the next year, you make more profit, but you also get to claim a tax deduction against it. Cool. They're the three main ways to minimizing a tax.
Yeah, mate, I just had a question about number two. I just
Yes.
wanted to clarify. You're talking about reducing income in terms of the money you're drawing from the business in a certain tax year rather than um, reducing or recognizing sales in a future financial year, right? You have to be careful about that. And then if you're doing the work for someone now, you need to be counting it in the current financial year.
Yeah, it's in it, for a small business, there's a bit of leeway of how you want to report your income, but it's based on basically when you earn the income. And for a small business, earning the income is based on when you send the invoice out or when the money hits the bank account. So you've got a bit of leeway and flexibility of how you report your income. Whereas a bigger business, like say 10 million, $20 million business, there's an expectation from the ATO that states that you have to report it, the general accounting principles. And the general accounting principles is basically when recognize it once the revenue has been earned, which means when you actually do the work. Yeah. So there's a bit of flexibility for small businesses, but the whole point is don't just do it for tax benefits. Just do it. Have some evidence that you haven't started the work or you're not planning to start it, or yeah, you're just pre-billing. Technically, I've got a client that she sells musical instruments, and those musical instruments are very expensive. Like talking about like 50K to 100K for that musical instrument. So when she gets a order in, technically she's made a sale and she gets 50,000, 100,000, and she just needs to get three of them, and that's 150K. So, but technically those orders are prepayments, and she hasn't actually made it's a pre-order, so she has to ship it from overseas or get the vendor to send it to her or send it directly to the client. So it might take a month or 2 months for that to get produced. So technically, that income she doesn't want to report as income because there isn't income yet. So it's technically a prepayment. So she's moved it to the balance sheet as prepayments, and it's like a liability for it to be either paid back to the client if the order doesn't get produced, or it will be showed as income in the next financial year when the order gets actually delivered. Yeah.
Yeah, so in that example, like it's more consequential
Yeah.
for her to, like at the end of the financial year, if she's doing a sale at the start of, I don't know, April or May,
Yeah.
and it won't be shipped and fulfilled until July. That's where it makes sense to shift it. If she's making a sale in like the 1st of August, she's going to recognize it in that year anyway, because it'll all be done by the end of the tax year.
Exactly. Yeah. And a lot of business owners don't even take that in consideration at all. They look at their income, they just go, oh, it's hitting my bank account. And a lot of accountants do the same thing. Hits the bank account, they just treat it as income. But there is a bit of flexibility, and a lot of people just don't know about it. Yeah. 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 Even my business technically can be, some of my deposits could be prepayments as well, because I actually haven't physically done the job. Yeah. I haven't produced a tax return. So technically, the money that hits my bank account is a prepayment for my services. That's because I ask for prepayments. But a lot of some accountants, the old school way of doing things is do the work first and then bill after at the very end. And so therefore, like the income has to be income because you've already done the work. But there is ways to play around with it and flexibility as a small business owner that people just don't know about. Cool, that makes sense. Same thing applies for expenses as well, which means that no, it's actually the opposite with expenses. There's a rule that says that you can prepay expenses even if you haven't incurred the expense and you're planning to incur it for the next 12 months. You can claim it as a tax deduction. So it works in your favor that you can actually shift your income. So sometimes, and people know this already, people get used to it, but it's just a psychological thing I do with clients is I always go to a client and just say, this is your income right now. If I didn't do anything, this is your net profit. And it works out to say that they made $1 million. And I ask them firstly, did you make $1 million in profit? And they look at their bank account. They look at like just from the last 12 months of work that they did. And it says they seem, because they've been in business for quite some time, they can kind of understand how much profit they have made in their head. And so when I explained that to them and said that you made $1 million, they like, oh, wow, that's a lot of profit, but that does make sense. And then I explained to them that they're going to pay 25% in taxes. So as a result, your tax will be then this amount here, 250K. So the client then goes, holy crap, I don't have 250K. They freak out. And then I then go, all right, well, your net profit's this. However, we haven't taken consideration these things, these three main things. We can shift profits to other entities. We can, reduce your income because some of the income that you've made may not actually be income for this financial year. It could be for next year. So let's look into June and July and have a look at that. Then also let's look at expenses that that you could prepay. So let's look at July, August, and September. Like let's look into the future. Is there any expenses that you can actually pay as well? And that's why it's really important to have your tax planning meetings between April, May, and June rather than July, because you can actually you can utilize this third method, which is increasing expenses before the financial year finishes. Yeah. And then as a result of this 100 of these meetings that we had with this client, we were able to kind of shift some of the income into super. So we put money into super. So in this case here, client had quite a fair bit of money and they had a lot of super contributions they could put. So we put about 100K into super. And at first they freaked out of putting 100K into super, but I said to them that you're actually planning to buy a commercial asset anyway, and buy a property. Why don't you just buy into super? Well, there is an option for you to buy into super, like that's because super has a tax rate of 15%. So as a result, they were able to reduce the net profit to 900K, but they also did other things, prepayments as well. So they spent another, $50,000 in prepayments, and they also purchased a car. So they purchased a new car, and that was about you can't claim the whole thing, but they claimed about 60,000 times 15%. So it was about 9K. They did some renos and other expenses. And then I think the last thing they did was they looked at their income and they said, you know what, I'm not going to start this job that's going to push this income higher. So they decided not to do a bit of work as well. And as a result, just by making these adjustments in April, May, and June, they were able to reduce the taxable profit by by 259,000, which then resulted to, their profit being this, and then they pay taxes of this instead, and it went down to 185,000 as opposed to 250K. So they saved $64,000 just from a tax planning meeting they had with us. Obviously, we had to forecast what their net profit was going to be, forecast what their tax is going to be, and then have some planning on what we should do to their taxes. Great thing is that you can actually do this yourself. But the things you need is you need your numbers. You need to know how much you're going to be making up to April, May, and June, or up to June financial year. And you also need some planning, effective tax planning with your accountant to work out what things you can claim and how much you can claim. I had one client though, just recently, we had a tax planning meeting with him, and then they thought that they could just spend, $100,000 in cars. And then that would mean that their taxes will go down by 100K. I said, no, you got to understand that when you spend 100K, there's something called depreciation on equipment. You can't sometimes always claim the whole thing up front. So depending on tax rules, you can't claim the whole thing. So just be careful when you're planning to spend money to minimize your taxes and minimize your profits. Not everything that you spend on will result to a direct tax deduction to your profit and then result to a tax saving. Some things that you buy, like cars, equipment, can't be claimed upfront and 100% of it. The only thing you can do, I said to him that if you spent $20,000 on a car or under, you probably could claim the whole thing upfront because of that rule, instant asset write-off. Yeah. And the rule changes, like sometimes it increases the limit, but now it's at $20,000 and that's the only thing you can claim. So just be careful as well with that. Even though he spent $60,000, he wasn't able to claim the whole thing. Cool.
Thanks. That's a really useful example, actually, to see it all broken out like that.
Yeah. So this is exactly how we do it. Perfect. Great. So I think okay, one last thing that we could do, which I didn't explain in this situation here, is in the future, you can also do tax planning for the future. So what you've noticed is that this person here made $1 million in net profit. Okay, this is a bit ridiculous in terms of like net profit for you not to do a restructure straight away, like beforehand of this happening. But just imagine that a sole trader made this income. So a sole trader making this income, it won't be 25% tax. It'll be, quite a high amount of taxes in their personal name, because any dollar over 180, well, 190K, I think it was. Sorry, got confused. I think it's not 90K, 190K now. Yes, will be taxed at 47%. So what you should be doing is knowing how much money that you're going to be making, and then during the financial year, knowing that, you're going to cross over 200K or 190K, then you should be actually restructuring your entity from a sole trader to possibly a company, or even some structure like this. Okay, why do we want to restructure something like this? Is having a trust gives you flexibility. Okay, you can't just openly, and this is where part 4A comes in as well. You can't just shift profits just like that. You can't just say, hey, I made $1 million, $200,000 goes to, my partner, another $200,000 goes to super, another $200,000 goes to offshore entity somewhere like in Hong Kong or whatever it is, or Singapore. You can't do things like that. You can't just shift the money away. There needs to be some sort of intermediary entity that helps you do that, and that's where a trust comes in, a family trust. A family trust gives you the ability to distribute profits. And a lot of people think that they don't need it and it's too late. So that's sometimes people try to implement this after the financial year, after they made $1 million. It doesn't work that way. You can't wait to making $1 million and then creating a family trust and then shifting profits. The family trust needs to own the entity that's making the profit for you to be able to pay a dividend, pay taxes into a family trust, and then let the family trust disperse the profits. So IRA works with me, and IRA has probably done some of these, our accounting for a lot of our clients. But if a client makes $1 million here, the owner of for option 1, in this case here, there's a net profit of $1 million. The owner of that entity is 100% the individual. So the only person that can actually get the shift of profits is this individual here. However, this individual also makes profit wages of 190K. So their tax rate is over 47% for every dollar that they get over 190. So you can't shift income into this person's name at all. And there's no flexibility to be able to shift elsewhere. So it's really important to actually consider setting up a trust and restructuring into a trust before you make too much money in your company. And then it's just pretty much impossible. Not impossible. It just will cost you a lot of money to restructure then. So why does it cost you a lot of money to restructure then? Is because when you shift and sell your shares from your personal name of this trading company that's making profit of $1 million and selling it to a trust or creating a trust, it means that there's a capital gain. So there's a rule with the ATO that states that if you're selling shares, arm's length, like as in with, not arm's length, within the family or people, and you technically need to have a market value calculation on that trading company. And if the company's making $1 million a year, and you're transferring at $1, that doesn't make sense to the ATO. So if they audit you one day and that they know that you shifted the company over to a trust, then they would ask, well, why is your business transferred at $1 when it should be $1 million? And I can see that because I can see your tax return showing that this company is making $1 million in profit. So that's where they hit you with an audit, and then they make you pay taxes on this capital gain and you didn't actually get any money for it. So that's where it can be a big problem for you, because you're technically selling it for $1 to the family trust. You didn't even get $1 million. So you had to cough up a tax on this individual. And because this individual is at 47% tax rate, could be 500K in taxes that you had to pay that you weren't even aware. And you didn't even get the money of $1 million as a result. It won't be 500K. Obviously, you can use concessions to minimize it, but it's better to just just before you start making serious money in this company, slot in a family trust, because then we'll value the business at a very low rate and we can transfer the business over to a family trust. And that gives you the flexibility to be able to distribute Now, having this this option here, option 2, gives you a lot of flexibility, because now you've got these tax rates that you can utilize, and you can utilize that 32 or a lower tax rate of, like, the 16% or 16% that we were talking about, because your partner doesn't make that much money. And might even have like adult kids that you can utilize as well. So you might have children over 18, maybe not now, but later in the future you might. And you could have mom and dad that also retiring and don't earn any Centrelink or don't earn any other income on the side. And then you could have a bucket company at 30%. This family trust gives you flexibility to be able to utilize everyone now. Opens up a lot of doors for you in the future. It's something that you need to consider doing just before you start making good money with the business. Okay, last thing as well is the SMSF. SMSF is very powerful, and I think I did a deep dive 2 weeks ago or maybe 4 weeks ago about super funds. Oh no, sorry, I didn't do a deep dive. It was actually a video that we released about super funds, where you can actually use the super fund to invest because for long-term assets. So you can actually start trying to get the money into a super fund as well. Obviously, there are rules. There's concessional contributions and there are limits. But the ATO does make it a bit easier for you to put money into super if you need to. You just can't put everything into super. I do hear a lot of people talking about the 3 million taxes that everyone's freaking out about. It's not a big deal right now because it's only like $3 million or over. That's the threshold, and it's per individual. So really, if you've got mum and dad or husband and wife in the super fund, they could have $6 million and not get the top up tax. And honestly, if it's topped up tax and it's 30% on unrealized gains, it's still cheaper than tax in your personal name. The only downfall is it's unrealized gains. Like you may have not sold it yet and you still have to pay the tax. But $6 million is quite a lot to have in a super fund. So it's not a big problem right now. But yes, the people kicking up a stink, it's because it can be a problem later on down the track because of inflation. So I actually think it's a really a silly thing to do as well. But yeah, it just means don't keep all your eggs in the SMSF. It means keep just enough for your retirement. $6 million is probably enough for you to retire on, and it's going to generate further income for you, and you can withdraw that, but also have a bucket company that you can also draw on to use later on down the track. Cool. All right. Does anyone have any other questions?
I actually have a question about the threshold for when you look at introducing a bucket company. So if you've got a family trust with a corporate trustee, at what point do you need to consider the bucket company?
Yeah, so I guess it depends on the effective tax rate of the overall. So what I mean by that is you need to maximize how much money that you're giving to yourself first. And that usually means anywhere between the effective tax rate of 25 to 30%. Right. So what does that mean in actual tax, like taxable income? So when you pay yourself about $100,000, your tax rate, your effective tax rate, if you don't have HEX, is $23,000 roughly. Total tax that you're paying on 100K is 23, which is pretty cheap. That's your effective tax rate. If you bump yourself up to 120K, your effective tax rate is about 30,000. A tax is $30,000. 30 divided by 120, I believe that is 25%. Yes, 25%. So you turn 25% tax rate for 120K. So if you pay yourself about 120K, that means you're going to be the same tax rate as the company. So rule of thumb is 120K. You could technically go up to 135K if you wanted to, but most people want to stay around this mark. Okay, like I said before, this mark here though depends on your disposable income. if you're spending a lot of money buying Ferraris, have a big mortgage, that's a big of an issue. And so therefore this money might have to increase to 190K. And yes, you're going to pay a more higher tax rate as a result, effective tax. But so that's 55K. If you do 55 divided by 190, it's about 28, 29%. It's still lower than the 30% tax rate in a bucket company. So that's why some of my clients, the high net worth, they like to spend, they like to show off a bit. Sorry, they don't like to show off. They just have big spending habits. They probably don't. They probably just want to spend the money because, they like expensive things. So as a result, 190K each, that's how much they want to pay themselves. And then if you're tipping over 190K, it's just not really worth it. You're paying 47% tax on every dollar that you're spending. But some people have to take it because they just, buying a Lamborghini or something like that. So, but it's a lot of money. So anyway, 190. If you've got a husband and wife, 190K each works out to be about 380. So once you got a 380, you can either decide to leave the money in the trading company, but I actually think once you're turning over about profit wise after paying yourself a salary, let's see, go back to 120 because most people are normal. Not everyone wants to pay themselves 120. You're talking my rule of thumb is 190. Say it's just by yourself, and you don't have a partner. If you're seriously considering a bucket company or distributing money to a partner later on down the track, you probably, I would say, anywhere between making another 100K on top of this, so you can actually distribute to the individual. You're probably talking about 220K. 200 to 220 is when you start setting up a family trust. It's important. Yeah. Because your argument is that you can distribute the profits to the individual here. Yeah. Or your partner. Some people, once they make about 150K, they decide, it's probably a good idea to set up the family trust. Because they can argue that 150K is wages and to yourself. So you pay the wages to yourself, then this trading company, or this one here, doesn't actually make any profit. The wages are being paid out. So therefore it's nil profit. Then that's when you transfer this trading company over to a family trust because it's worth nothing. Yeah. So that's the argument of doing it around that time. And that means 150K, including your salary or including your pay. That's when you do the transfer. Whether you use it straight away, maybe you might wait another year to generate another, 50K or 100K on top. And that's when you start using it to distribute profits to the individual or bucket company. You can still put money into super, no problems. You don't need a family trust to do that. But if you're planning to use other family members or a bucket company, you will need that money to distribute. You will need a family trust to distribute.
Sorry, just before you move on from that one, with with your trading company, 25% tax, you've got a trust that's working, you've got two people, one's working in the business, one's got another job, so there's a little bit of income, I guess, to use until they get to 190, and you've got super distributions, all of that stuff. What sort of figure is it useful to have in mind when you introduce the bucket company, when it's worth paying the 30% tax on anything that's going into the bucket company?
The figure, I don't have a figure. It's more, what do you want to do with the money? Yeah. So if you have a plan, and most of the time it's if you have a plan to invest, or you want to protect the money. Okay. So, because technically you could just leave the profits in the trading company. You leave in the bank account of the trading company, the tax rate is 25%, right? But then if you're feeling like the money's just sitting there, and say it's $500,000, and that's enough money for a deposit, you want to buy an asset with a property, then that's when you want to set up the bucket company, redistribute the profits from family trust to the bucket company, and then buy the asset in the bucket company.
Okay, so the bucket company is directly related to business investments the business might make, rather than the trust is all about the distribution to
Yeah.
family. Yeah.
Yeah, a lot of people say, why not just buy in the the trading company because the tax rate is 25%. I don't have to shift it. There's no need to have a bucket company on the side. The argument is that if you want to sell the business one day, if the business gets sued, they can go after the investment property or the investments in the trading company. And you want to separate it. And the second thing is also, if you want to sell the business, you're selling the property as well. And sometimes people don't want to buy the property as well. So you have to transfer it out, then you're paying stamp duty. You might as well transfer it out in the first place. Yeah. So to answer your question, there's no actual number. It's more like what you want to do with the money. Yeah. Cool. Yeah, that's a better way of doing it. So that's why sometimes we don't even tell clients to transfer to set up a bucket company until later on down the track. Yep. Cool. Any other questions? Isn't it bad to put money into super now with unrealized gains looming, 3 mil not index, better to buy in a buck company now for investments? Okay, so let me answer that first question. I think I already did, but I'll answer again. And I'll just explain. There's no indexation on this silly $3 million tax. So what does that mean? It just basically means that for the next 5 to 10 years, that 3 mil tax-free threshold, well, not tax-free threshold, that 3 mil threshold, it's not going to move up based on inflation. So when your property value goes up, it means that eventually you will hit over the 3 mil. And then as a result, you're going to have to pay the tax. Honestly, guys, you just got to time it well. Like for you to get $3 million, it's quite hard. Like if you, let me just do a quick research online. But what's the average balance for a super fund member in their 60s? You're looking at this amount here. So 500K, say. If you're an outlier, you're probably at 1 mil. So technically, they've done the research and they think that not many people will be at the 3 million. However, that's not to say in 20 years' time, that's going to be the same thing. So I reckon you're not really sure what's going to happen in 10 to 15 years' time, but it doesn't mean you shouldn't invest anyway because you got a better tax rate anyway in your super. So once you get to that 3 million mark or very close to it, then we worry about what we do. But hopefully, most of the time, we can just try to pull that money out. By that time, you might be 60 and we just take the money out and just keep it under 3 mil for every member. And remember, there's 2 members. So it's not just, $3 million for the total members. It's $3 million for each member. Okay. I have to admit though, you don't know the government. You can't control them. They might make changes. They might get trigger happy and just bloody decide to make super crap loads of changes that will result to it being not as friendly for super. But hopefully, right now, the intentions are still stay the same. Where else are you going to put the money? I'll be honest with you guys. If you can put it in the company, 25%, put it in the individual, 47%, it still makes sense to put money into super, especially when you're very close to retirement. So if you're close to retirement and you're, say, 10 to 20 years, super fund, self-managed super fund still probably makes sense to put money in there because then you can draw it out and it's tax-free. So let me just see if there's any other questions. What is the method used for a company creating a deduction on additional super payments? Okay, yeah. So basically, it just directly reduces the net profit. So I had that calculation here. You put super in here, it just directly reduces the profit of the company. Sometimes you might not want to reduce the profit in the company. So say this is the company. You rather intentionally put the money in from your personal name. So I've got this client that sold a property in their personal name and the capital gains tax is, $50,000 of capital gains. They made about a profit of like 200. I think it was a net profit of 200K on the in their capital gain, $200,000 tax on this. Technically it's 47. So I'm just going to use that argument, 47, 0.47. I just want to show you guys something real quick. It was split between 2 people. That's why it was like 50 grand ish. But say it's 94K. You wouldn't want to put them. What's the tax rate that they're paying in their personal name? It's actually technically 47%. So you shouldn't be contributing in your company name. You would actually want to contribute in your personal name instead, because the tax rate in your company in your personal name is 47%, but in your company it's 25%. So taking money out of your super, taking money out of your company that's taxed at 25, moving into your super, so you're saving 10% from 25 to 15%. Whereas depending on what you're making in your personal name, you might want to put it from your personal name into super instead. Just so you guys know. So you're actually saving, 15 cents minus this. So 32% if you put it from your personal name rather than in your company. Okay, but if it gets too confusing, speak to your accountant. Your accountant probably can, come up with the numbers. All right, so adding a bucket company, do you have the trust also holding the shares? Yep. So adding a bucket company, you'll have something like this. The family trust can own the bucket company. So because it's owned together, the family trust owns this and family trust owns this, then the distribution can go to the family trust and the family trust can then distribute the profits to a bucket company. Make sure the trust deed allows you to do that, but that works. And then the last thing is, what are your thoughts on investing in company versus, so the only reason why you'll move it over from investing trading company over to buying things in the bucket company is because you want to protect it. There are clients that just invest using the trading company. So I have a client that is making quite a fair bit of money every year. I think he's making about $600,000 in profit every year. He doesn't want to take the money out, put it in his personal name. He's already maxed his contributions in his super fund. So he's stuck with all this money, but he doesn't want to set up a bucket company because the business he runs is very low risk. There's barely anyone that would sue him. I can't tell you what he does, but it's very low chance of him being sued, and he could just close the company down the next day if he wanted to. Very, very good business. So what he's done with the profit is he's paid 25% tax on it. So 75% is left over, so 450. And he just took that money and invested it in crypto, ETFs, which is kind of like shares, and he is then hoping to make, a 10% return each year on that money. Yeah, so he's hopefully making 10% return on that money, and it's just sitting in his business account. So he created an exchange account with crypto, created an exchange account with ETFs and shares, and he's just taken that money and bought shares with it. The reason why he's done that is because it's liquid. He can transfer it out. He can sell it anytime, and then can transfer the money out if he wants to sell the business one day, which he probably won't. But it just gives him a bit of leverage against the inflation, basically. So the money just doesn't sit in the bank account doing nothing for him. Yeah, he could earn interest of 3% or 2 to 3%, but he thinks that he can make about 10%. Crazy thing is actually making more than 10% because of crypto. Yeah, and how much money is made recently. Couldn't you sell the business with that investment assets? Yeah, you can technically. It's just that the buyers don't really like that. They're buying the business, not the shares. Yeah, and that kind of creates risk for them. It's also very hard to transfer the shares over in the exchanges. And usually when you buy a business, there are two ways to buy a business. You can buy the shares of the company or the shares of the business, or you buy the assets in the business. So if you buy the assets in the business, you have to write up a contract and say, hey, I, XYZ, buy your client base, I'll buy your employees, I'll take over your employees, but I will leave your liabilities and other assets sitting in that company. So you kind of got an empty shell of a company, which may work in your favor, may not. So there are two ways to do it. So it's a bit of a pain in the butt. So in my opinion, yes, it's sometimes worth it paying the 5% to move it out for asset protection purposes. And I don't think that 5% is not that big of a deal, because remember, this company is making a lot of profit and you're paying taxes of 25%. And what you're trying to do is reinvest that money to make you more money. So you're trying to delay the amount of taxes you're trying to pay first before you pay it at the very end. All I'm doing right now is I'm borrowing these three main ways of doing things to technically minimize your taxes in the short run. So in the long run, you can make more money And then in the end, when you want to spend it, pay the taxes on it. Okay, so sounds very confusing, but what I'm trying to say to you is basically that 30% tax and that 25% tax you're paying in the company, eventually when you take that money out and you spend it in your personal name, you're going to pay the tax here. And if you take too much of money out, you're paying the 47%. So yes, sure, you're paying extra 5% by moving the money from the trading company over to the bucket company. But the beauty is that when you do decide to retire, Chris, say you're 60 and you decide to retire, you have no more money that's coming through the businesses. You have no wages. You can start taking a dividend from this bucket company. And that dividend, they call it fully franked. And there's a 30% tax credit on it. So that means that, say this bucket company has, say, for $2 million in net assets. I'm talking about 2 million in net assets after loans, and retained profits. And then the tax on that you've already paid taxes of 30% on that. So when you take money off the table from that 2 mil, say you take 100K, so minus 100. No, so actually, yeah, say 100 because it's just easier. You got to understand that there's already tax that's been paid on this. And the calculation is that, let me just do this calculation for you. This divided by 70 times by 30. So from that 100K, if you take this 100K out, 1 mil, sorry, I shouldn't, it's too much, too many zeros. So when you take that 100K out, you've already paid 42 grand worth of taxes. So therefore, that credit follows through to the individual and you get a credit for that in your personal name. So it's not like just because you pay these taxes doesn't mean that you can't utilize those taxes later on down the track. And that's the benefit of it. When you look at the whole picture, yes, because the whole goal, and this is where I think a lot of accountants don't explain it well. They say, why don't you just take the money out and pay the taxes in 47%? Even not just accountants, like business owners think that as well. It's like, I might as well just take the money out and I'll just pay the taxes of 47%. I'm going to pay it anyway. Why not just pay it now? And my argument is no, I think that's silly, paying high taxes, because what you're going to do with the money anyway, you're going to invest it. And when you invest it, won't you want to try to make use as much capital to invest early on? And so the compounding growth will then result to a higher amount at the end of the day when you decide to sell it. So 10 years later, you might sell the property. And if instead of investing $2 million, you invested that minus times, say, 60%, because you had to pay income taxes in your personal name, you're worth of 1.2 mil, and you buy with 1.2 mil instead of $2 million, then you're going to be left with a lower amount at the end of 10 years, because that compounding on itself, the growth, is going to be lower than $2 million compounding on itself. Yes, you're going to be paying more taxes in the long run because you made more profit, but you're going to be the one that's laughing because, yeah, sure, you pay more taxes. You still get a credit, and also you just got more money, disposable income when you retire. Yeah, so that's the benefits of doing this. Cool. Whole picture is, if you've timed your retirement well, a lot of business owners are thinking like this. I can't live off my super for the rest of my life. I can't wait till I'm 60. I'll retire when I'm 45 to 60, and I'll use my bucket company to pay myself dividends. There's a franking credit of 30%. I'll use that to fund my lifestyle from 45 to 60. And then from 60 onwards, I'll use my SMSF and a mixture of my bucket company to fund my lifestyle. So you can retire earlier. And that's how a lot of business owners are starting to retire, or not even just business owners, good investors as well, high net worth people, is that they still work when they're 45 to 60, but they just don't work as much. Or their company is paying the taxes for them, and they just take a dividend. And then eventually they will start taking money off their super fund when they're 60. So they will just let the super fund and their bucket company reinvest, compound the growth, and then pay the taxes of 30% and 15%. And when they decide to retire, they don't need to pay money in their personal name in taxes anymore, because the bucket company's paid for it, and the super fund's pension payments are tax-free. That's how it works. So really, how much profit should you offload from your company every year? So offloading to a bucket company, honestly, I would only leave enough money in my trading company for working capital, they call it, and that probably would be 6 months worth of expenses to 12 months. So let's just say that it cost me like, $2 million to pay for all my expenses for the year. I'll probably leave maximum $500 to $1 million a year in my trading company as profit, retained profits, and I'll transfer everything over to a bucket company. Okay. The only reason why I'm like that, I actually probably would leave only 500K in my trading company for retained profits. And the reason why I'll do that is because I like to invest and I like to let my money to compound. And I rather invest in a bucket company where it's safer, and then keep all my profits in my trading company, which I can get sued for because I give advice that clients can, easily go after me because I know that I'm a high net wealth individual, and also that I'm online and I'm an easy target. Well, people think I'm an easy target. So my goal is actually to transfer everything to a bucket company because I want to protect it. So I guess just leaving enough money for working capital is the best thing for your situation, because if you leave the money in the bucket company, in the trading company, and you're not planning to invest it, it's kind of wasted money to me. And I'd rather use it to invest. Cool. I think that's it. See you guys later. Thank you. Thank you very much, and have a nice weekend.